प्लेन और सिंपल वाइट शर्ट को बना दे स्पेशल और फैशनेबल। फॉक्स सेंट, न्यू फैशन वेयर फॉर मेन।
Hello and welcome to Bloomberg Quint Live. You're watching Trend Spotting. I am Shraddha Babla.
Good morning, Shraddha. I'm Agam Akil, and in the next 30 minutes, we deep dive into specific trends in the markets to draw out key takeaways and their implications for investors. First, the headlines. It is a strong start to the trading week with both benchmark indices trading with gains of over 0.5% each, and the Nifty holds above 10,550. Broader markets fall in line. And Simbhali Sugar slips close to 15% after the CBI registers a case against the company on charges of cheating Oriental Bank of Commerce of over 100 crores. And Sun Pharma, along with Dr. Reddys, are among the top losers on the Nifty owing to the recent regulatory issues faced by both companies. And Aster DM Healthcare lists at a discounted price of around 182 rupees per share compared to its listing or issue price of around 190 rupees per share.
All right, let's first take a look at how the markets are faring at this hour. The Indian benchmarks, of course, have extended gains led by HDFC Bank, HDFC, L&T and RIL as well. So the Nifty has advanced about 0.7% to climb back about 10,500. Sensex is trading stronger by 240 points. Mid-cap and small-cap indices are trading about 0.5% stronger, but trailing the kind of movement that we are seeing in the benchmark indices. It's auto, real estate and financials which are doing well in terms of sectors, while Nifty IT is under some pressure after 4 straight days of gains. The overall market breadth, however, is positive with about 1,200 stocks that were advancing, while about 500, there you have it, 420 declining. But India VIX has also fallen by about 3% to 13.7. VIX has actually, in fact, declined by about 17% or so in the last week, which has led some short-term stability to the market. 2 stocks that I want to point out. One is Stellite Technologies, which has risen as much as 10% today, and that is largely on the back of an order win of 3,500 crores from the Indian Navy. Also want to point out IDBI Bank, if we can pull that up, because that has been steadily inching up in the last few sessions. In fact, that's the only PSU bank which has actually gained in the month of February so far, and that also a notable 37%, and the other banks have fallen as much. PSU banks have fallen as much as 35% post the PNB fraud. So we need to understand what's happening in IDBI Bank, but that is trading relatively stronger. Oriental Bank of Commerce is weaker by about 9% after that CBI filed a case against Simbhali Sugar. So that's the picture as far as the broader markets are concerned. But Agam, you're also spotting some other stocks.
Sure. So I do want to pull up Sharda Cropchem, which is also advancing by as much as 9.6% right now. A lot of gains coming in on the back of some strong volumes as well. And there you have it. Specifically, the last 1 hour of trade has been very good for this particular stock. Navneet Education is the other stock which has also advanced quite substantially, or nearly 7%. It's just kept gaining through the course of the day. So a lot of gains coming in there as well. Let's bring up Oberoi Realty. That's also up 7%. That's also gaining along with several other realty stocks. So good gains coming in there as well. And on the losing end, of course, we have seen weakness in OBC, that's Oriental Bank of Commerce, on account of the new, new fraud developments coming along there as well. And of course, Sonata Software is also looking at some amount of weakness in today's day of trade, followed by Spark, that's also down by nearly 3.3%. So both these counters looking at some amount of weakness. But on the whole, at least as far as the momentum is concerned, it's still with the gainers, Shraddha.
Right, so then let's look at what we're doing on Trend Spotting today. First, we start off with the growth prospects for Advanced Enzymes. We asked the Managing Director, C.L. Rathi. And then we discuss Quess Corp's recent acquisitions and its inorganic growth plans with the chairman and managing director Ajit. And finally, we put the spotlight on HG Infra Engineering's IPO that opens for subscription today, and we cover all of this in the next 30 minutes.
Okay, so let's get into the first, aspect that we are addressing. That's the regulatory woes which continue for Dr. Reddy's labs, and the pharmaceutical major has received an establishment inspection report for its Srikakulam facility in Andhra Pradesh, with the US FDA maintaining that the official action indicated status. Darshan Mehta is, of course, standing by to tell us what this means for Dr. Reddy's. So, Darshan, tell us, how does it impact the company?
Yeah, so it does not bode well for Dr. Reddy's because this OAI and the US FDA has asked Dr. Reddy's for more details. Now, how does this impact Dr. Reddy? First of all, the street was anticipating that, since they only got 2 observations in the April 2007 inspection of the Srikakulam plant, this plant will be cleared, but that has not come in, and this will mean that, the resolution will take more time. Apart from it, that the chances of the plant may require a re-inspection could come in. Some of the important products, especially Copaxone, has been filed from this plant. The other products also there, including Dacogen as well as Propofol are there. It's almost 8 to 9% of the revenue. So overall, it's a negative view that, despite having only 2 minor observations and then getting an EIR on that front, the plant is still not cleared. There will be more time delays that is there. Credit Suisse has come in with a report, and they're saying that this is a big negative surprise. The financial impact will be limited because Copaxone has been delayed by almost 1 year, and this mellows down the hope of a quick clearance even for the Duwada plant, which is under much more serious observations. They're saying that the resolution may not be as immediate as the market may be factoring, and that is why Dr. Reddy's is down almost 1.5 to 2% in today's trade.
All right, thank you for bringing us those details, Darshan. So probably a lot that hinges on whether there would be a requirement for a re-inspection or not at the Srikakulam plant, but the stock is trading 1.5% weaker for now. But let's shift focus to Advanced Enzymes. That's another company which has been under the weather recently, with the stock trading with cuts of almost 17% so far this year. But it is gaining in trade today, higher by about 2.5% or so. So what have been the key factors at play for the stock, and what do the growth prospects for the company look like? Let's ask the management who's joining us on the phone line, the Managing Director, C.L. Rathi. All right, we have him live here. So, good morning, Mr. Rathi. Thank you so much for joining us here at Bloomberg Quinn. I just wanted to start off by asking about the operating margins which have been coming off since the peak that we saw in 2016 or so. I just want to know, what would you attribute this to, whether recent acquisitions or pricing pressure, and will these factors continue to weigh on the margins?
Well, see, if you look at our margins were abnormally high, like 48, 49% in the last financial year, because and then in 1 year we acquired 2 companies. As you know, no one in the, when you go for any acquisition, one of the acquisition which we did, Evox Technology, which was loss-making company which we acquired, but that gave us a very long-term gain now in terms of technology, because this Evox Technology has been on forefront for last 11 years in the area of directed evolution. What do you mean by directed evolution is you can create any enzyme the way like a god creates. So it's a completely man is directing the entire evolution process of enzyme product development. Now this kind of technology is really cutting edge technology. We acquired this company with 40 scientists in Germany. And naturally, this loss-making company would have a appropriate impact on our EBITDA margins as well as on our bottom line. But this is a very, I mean, we are very, very positive about this kind of acquisition, because this will give us a cutting edge in next 10 years to take on the global markets. And we aspire to be a global giant in our space. So we wanted this technology badly. It happened in this last 1 year. Also, we acquired JC Biotech, which was with that we became a substantial producer of an enzyme called anti-inflammatory enzyme called serratiopeptidase. So these two together are the major development. Even the JC Biotech was making very small margin, very small profit. So it also brought down our so-called EBITDA margins from such a high number of 48% to currently 41-42%, which is still very high. I mean, but we expect the similar kind of margin and sales growth to continue further.
And so, are we in line
Yes,
to get your full year top line estimates of around 380 to 400 crores?
Yes, we are positive about that. We shall be closer to 400 crore in this financial year, and our profit should be also more than the last year, which itself is a huge gain, because with the two acquisitions we are still able to make profits more than the last year. That itself should be a very, very positive factor.
Sure. So, sir, the December quarter performance, of course, they saw strong rebound over the last year. How have the months of January and February been? And just trying to understand if we can see a similar level of performance in the fourth quarter as well.
We already told that. We already communicated long time back that we will be maintaining our overall number to around between 380 to 400. And of course, since we already done now somewhere around 286 in the up to 9 months, so that means another 100 odd crore will be positively there for the coming quarter. So not an issue.
And sure, so if we talk a little more longer term, over the next 2 or 3 years, which segment and which geographical region do you believe will drive growth? That is, are you expecting any sort of outperformance from the US business or the domestic business, and broadly, what's the demand environment looking like?
See, US is something which we are very upbeat about, very, very bullish on US development, because as you know, our US company has been in nutraceutical business for over last 30 odd years, and that is the one area which we are really looking to expand faster now. And our nutrition is our main focus. As such, 75% of our revenue comes from human nutrition and roughly 15% from animal nutrition. So nutrition we are very bullish about between the two portfolios, and followed by that is the food sector, food enzymes for nutritional purpose, and enzymes for biopharmaceutical. Again, on like after acquisition of Evox technology, we are able to take on assist so many pharma companies with green technology to create high quality products using enzymes. So that is another one area where we are quite bullish.
Right. So can you also give us an idea about how you're seeing your palm extraction business develop, and if you can give us an outlook in that business as well?
Well, palm extraction business is currently still in the development stage, and we expect the revenue to start flowing in the 1920. We don't see too much revenue in the next financial year, but we see revenue start flowing in from the year later. And there are like a lot of positive developments there too. We have a team of people working in Malaysia, team of scientists working here in India, and a few things are already happening out there. But the revenue and the profit should start flowing in 1920. That is next financial year.
So you spoke about the US markets, earlier. I just wanted to understand is that a substantial shift in change in policy, and if so, how are you adapting to the change in regulatory environment when it comes to the US and your nutraceutical segment?
Well, as you know, if you carefully studied our company, then we had a product recall in 2013, and from there onward, we really learned a lot of hard lessons. And we were very, very proactive in regulatory aspect. So fortunately, we went through several audits in the process. We completed our entire re-audit of all our facilities, all our operations, and that has made us now very, very strong contender to take on the US market.
Sure. So what is the kind of funds that you have earmarked for inorganic growth and acquisitions over the next 2 years, and also a word on the capex and R&D spends?
Well, you must understand, we don't need any capex as on today or next 5 years for our growth from current level to say up to 1,200 crore of top line. So we are completely sufficient on capex as far as that is concerned, and we have very strong cash flow. We are completely debt-free company, Now looking at that and with a almost 120 crore, 100 crore plus cash flow coming in, we are looking at deploying most of the cash in inorganic growth of the company. And we are not yet like, I mean, there is no such exact number, because unless it's a proper company in the site, we cannot comment about it. But we'll be using all our capex or cash generated predominantly to grow the company to bigger level.
Sir, what would be the current capacity utilization levels?
About 45 to 50%, below 50%.
All right. Also, sir, a sizable portion of your revenues...
Because we normally don't look at capacity utilization here.
Right. So your sizable revenues also come from a single customer with a revenue contribution of about 14 to 15%. I just want to understand what is the kind of or nature of contract that you have with this customer. How many years have you been dealing with them, and also what are the efforts that are going into reducing that customer concentration risk?
Well, there are two ways of reducing customer concentration. One is because you want a larger customer. See, from a small Indian company becoming a mega player, we'll have to take on the big customer. Now, this customer, who is now our major customer, has been with us for last 7 years now. And they started small, but they could grow our enzyme portfolio, their business much bigger. It's a very major revenue for them. And because the product was completely developed only for them, and they don't go anywhere, they don't buy that product for anyone else, and the growth has been pretty spectacular. So this company would continue. We don't see any threat in that direction. And to mitigate such risk, we're looking at acquiring more customers of that size.
Right, sir.
Those who can give us $10 million, $15 million enzyme business. Yeah.
Right. So just a final question then. Has there been any impact on the bottom line when it comes to reduction in corporate taxes in the US?
Yes, we will get positive advantage. Our tax outgo will be lower in US, also in India, both sides. So you will see much positive benefit to our company, because as you know, we have been full tax paying company both sides. And even our Pithampur plant, which is a SCG plant, also is going to be out of tax for tax benefit from the next financial year. So we will now gain positively from both the development here in India as well as in US.
Okay, Mr. Rathi, we leave it at that. Thanks for joining us and giving us an outlook on Advanced Enzymes, the company as well as sector. And of course, it's been a pretty important company considering the niche that the company has made in the stock markets, of course. But we'll move across and address yet another sector in the next aspect that we are addressing today. The acquisition seems to be the word for Quess Corp. And the company has recently acquired Monster's India, South Asia, and Middle East business, and will be paying about $14 million for this. And Quess Corp also acquired the care business of HCL Services, which is a subsidiary of HCL Infosystems. Let's discuss these in details with the company's growth plans with the chairman and managing director, Mr. Ajit Isaac, who joins us on the phone line. Mr. Isaac, good morning and thanks for joining us. Let me just start off with Monster's acquisition. A lot of this has been discussed as to the reasons behind you're venturing into and this particular buy. But if you could give us more details about what Monsters can do eventually, say in the next 2 or 3 years for Quess Corp.
Sure. So we're very excited about this transaction where we've been able to acquire Monster's assets for India, Middle East, and Southeast Asia. As you're aware, Quess started off by being in the employment business through our investment in IKEA Human Capital Solutions, the company that grew on to becoming a staffing major, India's largest staffing company today. We employ, all found in Quess today, about 250,000 people, out of which about 150 to 160 is in the staffing space. So clearly we've been familiar with the process of how you acquire a candidate, convert him into an employee, you payroll him through his entire life cycle and severe him. Monster gives us the opportunity to be able to acquire candidates through the platform that Monster has and build out a workforce management platform progressively from that starting point. So we think that Monster gives us the ability to create such a platform from scratch. It's a great brand, and it's got a fantastic geographical footprint from India, Middle East, and Southeast Asia, and represents a huge opportunity as Quess transforms itself from just being a staffing company providing managed services into becoming a complete employment solutions company.
Good morning, sir. Just wanted to understand what the EBITDA and PAT margin profiles are of both the acquired entities. This is the Monster business as well as HCL's care business, because I believe this is not something that you have shared so far.
Yeah, Monster is a company that does approximately about $26 million of sales, $27 million of sales, and it's a company that is just about breaking even. We think that some more investments are necessary for this year, so it's not all our investments are for the long term. We've never sold an investment in the past, so we think that it will require some more cash as we keep transforming it from where it is. But it represents a large opportunity for us in terms of building value for our shareholders. Just as a point on this, as you would have seen, we bought the company at about approximately half-time sales. In the stock markets, if you were to look at other internet properties of this type, they trade in multiples of revenues going up double digits. So the upside for us as we keep creating value in this company is tremendous. In the case of HCL Care, the company does approximately about 200 crores of sales, and it presently does about, let's say, about 5 or 6 crores of EBITDA. We think it has the potential to reach about 7 or 8% EBITDA margin and acquire at least about 20% sales growth every year on year. So that's the outlook for both these companies.
Right, Mr. Isaac, your third quarter has been extremely strong and, not unlike what we've seen in the first half of the financial year as well. My question then is that at least for the foreseeable future, and by that I mean at least the next 4 quarters or next financial year, can we expect this strength to continue? And if this strength does come, will it be largely organic, or will you continue to get in more acquisitions on the back of which we can see, your growth in the top line as well as the bottom line?
That's a good question. I've always emphasized that the biggest value that is represented in Quess today is of the businesses that we already have. We've grown very strongly in this last financial year. Our revenue growth has been 48% over the previous year. EBITDA growth 52%, and PAT is at about 70 crores right now. So we are ahead of our targets in terms of organic growth. Compounded annual growth rate for the last 7 or 8 years is approximately 45%, out of which 33 has come through organic growth and maybe 12 through inorganic initiatives. So we're largely a company that's grown through organic growth and not as much through acquisitions, although they've helped us create new verticals when we wanted it. But I think the focus in our company is clearly on organic growth. So while you've seen us do multiple acquisitions, actually 22 of them over the last 10 years, what they've given us are stepping stones and springboards to new businesses rather than accounting for revenues all by themselves.
All right, sir. And, my final question will have to do with the fact that is it possible that your margins can dilute further on account of your inorganic policy, say in the next 2 or 3 quarters, or for that matter, the next 1 year?
No, actually, our margins have grown to 5.74% in the last, in fact, 14 basis points has increased in the last quarter alone. We think there's a further upside to our margins and further expansion to our margins. We are closer to 6% as we will exit this year's margins at. Some of these businesses that are turnaround businesses are more or less break-even ones and don't contribute too much by revenues right now. It's not going to move the needle by too much in terms of the margin profile of the company, but they represent opportunity stacks for value increases for our stock in the future because they are growth businesses, they're turnaround businesses, and when they start contributing, there'll be huge upsides to that.
Right, Mr. Isaac, thank you very much for joining us here on Bloomberg Quint. Appreciate your time. So that was the management of Quess Corp saying that despite acquisitions, organic growth remains a key strategy for the company. But let's shift focus to the new kid on the block, which is construction company HG Infra Engineering, and it's 462 crore IPO, which is open for subscription. Soumit Sarkar is standing by with a snapshot of the company's business and its public offer. Soumit, tell us more about the company.
So it is the 6th IPO in the first 2 months of 2018, and this company is looking to raise as much as 462 crore rupees at a price band of 263 to 270, and at the upper end of the price band, that is 270, the company is valued at close to 1,760 crore rupees. Now the entire IPO is a combination of offer for sale and a fresh issue, and 4 promoters will be selling shares worth 162 crore rupees in the offer for sale, while the company is raising money close to 300 crore rupees to repay its debt and to buy some capital equipments and for general corporate purpose. Now, if you see, HG Infra is a road construction company which has small exposure into water pipeline projects also. Now, the company generates most of its revenue from public sector clients. As you can see here, 54% of its revenue in FY15 came from public sector companies, which increased to 73% in FY17. And for the first half of financial year 2018, it stood at 66%. Now, the public sector clients of the company includes NHAI, PWD, MES, and the Jaipur Development Authority. Now, if you see, the company has is into mainly roads and developing highways. In FY15, it generated 86% of its revenue from developing and constructing roads and highways. Similar was the case in the first half of financial year 2018 also. Now, if you see, the company has presence in various states like Rajasthan, Uttar Pradesh, Haryana, Uttarakhand, Maharashtra, Arunachal Pradesh, but it is the state of Rajasthan which contributes the most to its total order book. Now, in FY15, the 38% of its orders were from the state of Rajasthan, which increased to close to 45% as of November 2017. And as of November 2017, the company's total order book was close to 3,700 crore rupees.
Soumit, but more importantly, how does the company's financials stack up, and how does it stand as compared to some of its peers?
So, if you compare with Dilip Buildcon and KNR Constructions, the growth rate of the company is very good. The company's revenue, net profit and EBITDA grew at a compounded annual growth rate of 34%, 37% and 28% over FY13 to FY17, which is better than Dilip Buildcon and KNR Construction. But on the balance sheet side, if you see, the company's book value is the lowest and it has a very high total debt to equity. If you can go to the next chart. Its total debt to equity is close to 1.7 times, so this will come down to 1.2 times as the company will be using the IPO proceeds to repay its debt. On the return ratio side, the return ratio is very impressive. For the annualized FY18, the return on equity is close to 25%, return on capital employed is 30%, while return on asset is 7% for the company, which is the highest compared to Dilip Buildcon and KNR Constructions. On the valuation side, if you see on PE, on the price to earnings, the valuations are a bit expensive compared to Dilip Buildcon and KNR Construction. But on FY18 EV to EBITDA, it is at par with its peers. At FY18 EV to EBITDA is 12.5 times, while that of Dilip Buildcon is close to 13 times, and that of KNR Construction is close to 12 times. Lastly, if you see brokerages, Angel Broking has a neutral rating on this IPO because of its limited track record and concentrated order book. But the other two companies, that is ICI Direct and IIFL, have a subscribe rating on this IPO because of the strong growth prospects that the company has going forward.
Right, so on the basis of return ratios and the price to earnings, it seems that the bankers have largely priced it in line with the peers, if I'm not mistaken, Soumit.
Yeah.
So, well, okay, so thanks for getting us those details. Of course, so we will keep an eye on how the subscription, pans out for this particular company, but we're out of time, so we're wrapping this edition of Trend Spotting. Don't go anywhere. Up next is Hot Money, so stay tuned in the Bloomberg Quint Live.